Hello. Welcome back to Option Bank, your premium options trading platform. In the last video, we had helped you understand the concept of hawkish and dovish central banks. Today, we will consider how this bias creates impacts on the market. As we have discussed, doves and hawks are terms used to portray governments or policy makers based on their support for tight or loose economic policies. Doves often have a much softer view on economic events and policy actions compared to hawks. Doves believe that the negative effects of consistently easy economic policy such as low interest rates and high government spending can be offset in the larger scheme of things due to growth in productivity and household wealth. Hawks, on the other hand, believe that every economic policy and tool should be used in moderation. They are concerned about the negative effects of easy policy such as excessive speculation, rapidly rising inflation, higher borrowing and risk-taking. They believe that these actions can all lead to a big bust when future reality turns out to be less rosy than expectations. However, to judge a central bank or a policy maker to be hawkish or dovish all the time, a bank's hawkish or dovish stance largely depends on the period of time being considered. Let's consider an example. The subprime loans crisis pushed the US into a recession in 2008. At that time, the US Federal Reserve employed many policy steps to prevent the system from collapsing. It lowered the prime lending rate to nearly 0%. It purchased unprofitable assets that were on the balance sheet of banks. These investments, such as agency debt and mortgage-backed securities, were causing big losses to banks holding them. By buying these toxic assets, the Fed freed the banks to reinvest available capital into the system to encourage economic activity. This second type of stimulus is known as quantitative easing or. Due to these measures, the Fed was labeled as a dovish central bank from 2009 to 2014. After years of encouraging growth and recovery, the Fed gradually started considering raising its interest rates and tightening its policy, once the system started showing signs of stability and self-dependence. As a result, the Fed raised interest rates for the first time in the last 10 years, in December 2015. As the situation improves further hikes are likely to show up in 2016. So how do these easy and tight policies affect the markets for assets like currencies, commodities, stocks and bonds? Tightening monetary policy reinforces the strength of the country's currency since higher interest rates on deposits induce consumers to save rather than spend. Short-term deposits are generally favored during such periods to take advantage of rising rates. Tight economic policy dampens the attractiveness of the stock market, as higher interest rates reduce investment by companies, which can slow down their growth and profits. Higher interest rates reduce the attractiveness of bonds compared to regular savings deposits, as deposits can be more liquid and easy to hold compared to bonds. Thus bond prices fall as investors demand a higher yield on bonds to invest in them. Tighter policy and higher interest rates can slow down demand for commodities as individuals and companies save more and spend less. This can moderate consumption levels and economic activity, and reduce the demand for commodities. In conclusion, the significant effects of monetary changes should be used to one's advantage, than to be feared. Deep understanding of the nature of a central bank's monetary policy will help traders determine market sentiment and overcome the fear of sudden sharp moves. Thank you for watching.